If you're watching this video, you probably think silver is just another commodity, a little brother tagging along behind gold. But that's exactly the kind of thinking that keeps most investors from seeing what could be the single greatest wealth opportunity of our generation. So if you're here right now, I need you to listen very carefully. Silver isn't just a shiny metal. It's the most strategically critical asset on the planet, caught in an epic tug-of-war between collapsing monetary systems and an explosion in industrial demand. And the shocking part? 99% of people have no idea why silver could be set for its most dramatic price surge since the Hunt brothers tried to corner the market back in 1980. You need to understand this. Silver today is profoundly undervalued, not just compared to gold, but also against its own inflation-adjusted historical highs. This brings me to the second critical point, something most people simply don't know. The global silver supply is in a state of structural collapse. Over 70% of all silver mined isn't from primary silver mines. It's just a byproduct of mining for other metals like lead, zinc, and copper. This is huge. It means silver producers can't just flip a switch and ramp up production when prices rise. To get more silver, you need a massive surge in industrial-based metal mining, which is actually slowing down due to economic headwinds. So we have a rigid, inelastic supply. At the exact same time, industrial demand is accelerating far beyond what miners can produce. The solar panel industry alone consumed over 180 million ounces of silver last year, and that number is set to grow exponentially as nearly every major economy on Earth pushes aggressive green energy targets. We're talking about a fundamental physical deficit that is growing larger every single year. While this supply and demand crunch is happening, something else is going on behind the scenes. Investment demand is quietly on the rise. Major institutions, including some of the very same banks that were once accused of manipulating silver prices downward, are now steadily accumulating physical silver. It's no coincidence that the registered silver inventories on the big exchanges, the COMEX and the LBMA, have been drained down to critically low levels. Historically, when inventories get this thin, it's the prelude to a major price breakout. Wall Street won't tell you this. The financial media will gloss over it. But by the time the average person finally realizes what's happening, silver will not be trading in the double digits anymore. We are witnessing a perfect storm: monetary debasement from endless money printing, a structural supply shortage, exploding industrial demand, rising geopolitical risk, and a historical undervaluation, all converging at the exact same moment in time. And here's another unique property that makes silver so different from gold. Silver gets consumed. It gets used up and thrown away. Nearly every single ounce of gold that has ever been mined in human history still exists somewhere, either in a vault, a coin, or a piece of jewelry. But over 60% of all the silver ever mined is gone forever, lost in landfills, inside discarded electronics, and other industrial products because it's simply too expensive and difficult to recycle it from them. This means silver isn't just undervalued, it's effectively becoming rarer with each passing day. The physical stockpile is shrinking, not growing. Let's look at history for a moment. The last time we saw a similar set of conditions for silver, it went from $4 an ounce to $50 an ounce in less than a decade. Today, the supply constraints are arguably even tighter. The monetary instability is far greater, and our industrial dependency on silver is exponentially higher than it was in the 1970s. When the global green energy transition kicks into high gear, some analysts predict that silver demand could outstrip supply by more than 150 million ounces every single year. And unlike oil, you can't just drill more holes in the ground to find more. What's coming isn't just some speculative guess. It's a mathematical certainty. It's a supply shock colliding head-on with currency devaluation. If central banks around the world continue printing money to service their massive debts and to stimulate their economies, tangible physical assets will continue to outperform paper promises. And history shows that during periods just like this, the high inflation of the 1960s, the stagflation of the 1970s, and the commodity supercycle of the 2000s, silver didn't just outperform gold, it vastly outperformed it in percentage terms. The imbalance we see today is far more extreme than in any of those previous cycles. That's why, if you are still watching this video, I urge you to subscribe to this channel right now, because in my next videos, we're going to dive even deeper. I will reveal the actual price targets to look for, the realistic timeline we can expect before the next major surge, and the hidden ways market manipulation has held this explosion back. More importantly, I'll show you how you can position yourself before the window of opportunity closes for good. I want you to leave your thoughts in the comments right now. Do you believe silver is stuck under $30 forever? Or are you starting to see the possibility that we might be on the verge of a multi-100% move that Wall Street is terrified of you knowing about? Get involved in the conversation, because our analysis isn't based on hype. It's built on historical data, mining economics, institutional money flow, and macroeconomic cycle analysis that you won't see on the mainstream news. To understand where silver is heading, you have to ignore the emotional noise and focus on pure, hard, macroeconomic logic. Let's start with debt cycles. Throughout modern history, every single time a major fiat currency has collapsed, it has triggered a massive surge in the value of real assets. Right now, the United States is sitting on over $35 trillion in national debt. That number is growing by nearly $1 trillion every 100 days, and there is absolutely no political will to stop it. Historically, when a country's debt-to-GDP ratio crosses the 120% threshold, governments almost always resort to a stealth default. They do this through inflation and by deliberately devaluing their currency. This is where silver has a unique advantage. Gold reacts to monetary fear, but silver reacts to both monetary fear and technological acceleration. This dual nature means its price movements can be far more explosive. Consider the dilemma central banks are facing. If they keep interest rates low to prevent a collapse in the treasury market, inflation comes roaring back, which pushes silver higher. But if they raise interest rates aggressively to fight inflation, they risk triggering a deep recession. A recession would cause global mining output to drop, restricting supply, which also pushes silver higher. Under current central bank policies, there isn't really a scenario where silver doesn't appreciate unless you have a complete simultaneous collapse of global demand. And that would only happen in an extreme economic freeze where supply chains break down entirely. Even then, commodities with high purchasing power become essential tools for trade. Now, what about the accusations of price manipulation? They are credible, but they are not a permanent factor. Back in 2010, J.P. Morgan was fined for manipulating the silver market. Since then, regulations have tightened, but short-term algorithmic suppression likely still exists. However, this manipulation has its limits. Under stress conditions, like when margin collateral requirements rise, these short positions get squeezed. This forces short sellers to buy back their positions, which dramatically accelerates price movements. The silver market is incredibly thin. It would take less than $5 to $10 billion to effectively corner the entire silver futures market. For institutional funds, that's pocket change. For comparison, it would take over $200 billion to have a similar effect on the gold market. So when these large institutional players finally decide to rotate into commodities, which they likely will during the next credit event, silver is positioned to be one of the first and biggest beneficiaries. Independent commodity tracking groups are already running the numbers. Many analysts estimate that by 2026 or 2027, we could see a structural break above $50 per ounce. And if supply chains can't keep up with demand, silver could test $80 to $120 by 2030. In a full-blown sovereign debt crisis or a global monetary reset, Hyperinflationary conditions could send silver far beyond its historical inflation-adjusted highs. We could be looking at prices approaching $200 or even $300 per ounce. That would be the equivalent of the 1980 silver peak, but adjusted for the massive expansion of the M2 money supply since then. So, when will this all happen? Timing is everything. Typically, silver lags behind gold during the early stages of a panic, but then it dramatically outperforms during the mid-cycle monetary repricing phase. Right now, gold is leading the way, testing its all-time highs. This is a classic early indicator. Once central banks around the world begin cutting rates and liquidity floods the markets, silver's upward momentum is likely to accelerate rapidly. This process could begin within the next 12 to 18 months. Remember, smart capital moves ahead of policy action, not after it. Just look back at the period from 2009 to 2011. Gold rose 80%, which is impressive. But silver exploded by over 400%. The imbalances in the system today are even larger than they were back then. So, what's a sound investment strategy? First, avoid using leverage unless you truly understand the risks of margin calls. The volatility in the silver market can be brutal. The safest way to invest is through physical silver, coins, bars, or allocated accounts. After that, you could consider mining equities, but focus on companies with low-cost operations and high-grade reserves. Look for those that are primarily silver producers, not those that get it as a byproduct. ETFs are an option for liquidity, but they come with counterparty risk, which is a major concern in a crisis. Most importantly, you have to learn to ignore the short-term noise. A volatile drop from $30 down to $22 doesn't invalidate a long-term trajectory toward $100 or more. Silver bull markets are known for being violent and seemingly irrational. They typically don't end in a slow fade, but in a sharp, dramatic peak followed by a new, sustained, and elevated baseline price. Here's the bottom line. Silver is on the verge of transitioning from a speculative side metal into a strategic global asset. It will be a critical component in the energy transition, monetary hedging, and industrial scaling all at the same time. Rethinking its role isn't just an option, it's a necessity. The fundamentals are all aligned to suggest sustained price appreciation for the next decade, with the most aggressive surge likely happening within the next 2 to 4 years. If you're watching this, you're already ahead of 99% of people who dismiss silver as just poor man's gold. They don't understand that historically, during the late stages of debt cycles, silver often becomes the accelerator metal. Knowledge gives you leverage, but only action creates impact. If anything in this video shifted your perspective, don't just leave silently. Engage with the content. Comment below if you think silver will break into triple digits. Subscribe if you want to see our next video comparing the silver and uranium sectors. And share this video before the mainstream narrative flips. You came here for the truth, not for hype. And this is it. This isn't just speculation. This is what happens when economic inevitability meets market ignorance. That window of opportunity isn't open forever. Get informed, stay vigilant, and prepare.